Okay, everyone, thanks for joining us today. We're going to cover, this is a study hall to go over volume profiling concepts. We're going to cover several things here that I think are important. Derivatives trading is not suitable for all investors. Past performance not necessarily indicative of future results. What we're planning to cover today, we're going to look at market price discovery process, the auction, just boiling it down to the basics again. We really need to be grounded in the basics of how the market operates. Not many people kind of give this enough attention. They jump into technical analysis immediately. Market versus volume profiling and examples. Not sure why this one's popping first, but okay. Characteristics of a VP. We're going to look at the different portions of a VP, a volume profile, and what they're telling us. Trading value and establishment of value, and trading concepts using VP. So we'll end this by talking about a few kind of simple ideas that are established within the profiling world concepts, going way back to 1982-83 with Pete Stadelmeyer. So we'll finish up with some actual trading examples. And for today, just to change things up, I'm going to ask questions near the end, and I'm also going to use crude just because it's not familiar to many. So first things first. So the price discovery process, as traders, we're a member of the mechanism that advertises price as a taker or maker. In other words, each one of us is our task or our participation in this really boils down to our ability to come in, look at price, and either take the bid or the offer, and therefore take the next price up when we take the offer, right? So we're buying, or take the next price down when we take the bid, we're selling. So we're a taker, or we are facilitating the auction in the other direction, which is we're a maker. In other words, we're making markets, or we're providing liquidity and helping facilitate that price discovery process. Many times you've probably heard that day traders and speculators are the bane of the markets. They're the ones that cause all the the run up in Bitcoin in when was it, 2017, December 2017. That's just crazy speculators, and it doesn't really work that way. Like everything else, there are some negatives to everything that we do, as well as there are positives. But you as a trader are actually providing a very important service to the economy and to global trade, in that you are participating by providing liquidity to the market that is very much needed. The more liquidity the market has, the more orderly it is, not the opposite. Versus when there are no speculators and there aren't enough participants, you have a market that is very jarred and it hops around a lot. If you've ever looked at RBOB gasoline futures, or something that's very thin like an OTC or a penny stock, we help provide quality, bring quality, that liquidity that the market needs. Okay, so we're either a price maker or taker. Price moves pretty much, my background's in engineering, and I see everything in terms of physics a lot. Probably drives people like Yoda nuts because he's an accountant. Price moves like objects in a vacuum using Newton's laws of motion. Okay, what are Newton's laws of motion? There are three, but we'll just cover the first one. Price maintains in directional motion until a force acts on it. So generally, prices will continue in a trend until the force, meaning the opposite side, there are two forces, there is buying and selling here, until an opposing force comes in and acts on that price, and then you get a reversal, or you get a potential balancing behavior for the meantime. But if that force doesn't come in, you have essentially these big sell-offs because the buyers are not willing to step in. That force is missing. So it's kind of like Newton's laws of motion, the first law of motion, where objects in a vacuum continue in their direction until a force is applied to it. Price moves until sellers are motivated to push back. Price advertises down until buyers step in and stop it. That's a very, very, very important concept to understand. The reason price turns is because traders believe it is below value to buy or above value to sell. So generally, price will continue higher and higher and higher until enough participants or enough volume comes in and sells that product, and now we have something that is starting to reverse or change. Okay, otherwise, don't go against that force. Don't go against that momentum. That's the bottom line. And how does this tie in to VP concepts, which is the subject? The volume profile or the market profile, which is the earlier tool, still very valid today. Many, many, many big traders use market profiling still. What we're doing is we're measuring not only the direction, but we're measuring how much force there is at each price. Okay, so we'll get into that in a second. The market is constantly seeking equilibrium. It really wants the market's best condition is when both parties agree on price and find a reasonable price, and then now there's a lot of commerce going on. So you look at China and the US in a trade war, and the way to upset the flow of goods between China and the United States, and unfortunately it's a lot more from China than to China because of the manufacturing, but the way to upset that is to force through tariffs, as the current administration is doing, is to force a price change, and then the flow of goods kind of slows down. That's what they're after. So you tax the people who are buying the product by changing prices, causing values to go up, and by causing values to go up, demand goes down, volume goes down, and so on. But left to its own devices, the market is intended to find an equilibrium price without, a government intervening or anything like that. It finds an equilibrium price, and then commerce occurs, and it's usually at the best buy and sell point at that point. When tariffs are applied, we are changing the price discovery process, and it forces both sides to act, and usually they withhold supply, or demand is being withheld, and therefore there's no volume going on. So the volume profiles are simply measuring how much at those prices. Okay, this is why it's important to me. In an auction market, there are never more buyers than sellers. So if you've ever heard that the market's going up because there are more buyers, this is completely untrue. There is no such thing as more buyers than sellers. That can never exist, because there can't be, for example, 3 million buyers and 1 seller and 3 million contracts traded. No. How many contracts traded if you have 3 million buyers and 1 seller? How many contracts traded? Type in your answer in the chat box in front of you.
Yes, stumped them. Everybody's saying 1.
Correct. 1. Just 1. Because there's only 1 seller. Just 1 person got filled, and 2.999.9, 9999 did not get filled. Why? Because there's never more buyers than sellers. It's 1 seller and 3 million buyers, then it's just 1 contract traded. And the opposite is also true. Okay, so this is also an important concept to remember. So what we're measuring at every price is how many contracts were agreed upon to exchange hands as value. Very, very important to get this. This is what we're building up to here. When we look at how much traded at price, this is simply telling you how many contracts, not participants, but how many contracts went off or exchanged hands at that price. This tells you at that price how much buying and selling interest there is at that price, which this indirectly describes, or actually directly describes, how much the market is accepting that price. Okay, so let's break it down to the two concepts, market profiling versus volume profiling. Market profiling consists of these things called TPOs, time price opportunities. Time price opportunities. You don't need to remember that. A TPO is simply a letter. It's simply a letter that represents a 30-minute increment of time, and then you gather all these letters up. So these are 30-minute bars represented at each price with a letter, and then you accumulate those letters to the left or to the right to form a histogram. That's what a TPO is. So TPO does not tell us anything about volume. Does not tell us anything about volume. It tells us something about time, how much time a market has spent in 30-minute increments. It is not a trading system or methodology. MP is simply a way of organizing data. The advantages of MP is it makes it easy to see where the market has spent the most time, make it easy to see acceptance, high volume nodes or point of control that it represents acceptance, or rejection, which is represented by low volume nodes in single prints. Disadvantages does not give you any perception of how much traded anywhere, how much of it was there. There are also many misconceptions about what it is telling the trader. There's a lot of misinformation, I think, on market profile when you look around that really the profile is not able to provide, like these ideas, like if the market opens up above value and goes into value and closes a 30-minute bar within value, it has an 80% probability of touching the other side. If you test that, it's probably somewhere around 50%. It doesn't have that high a probability. So there's some misconceptions about how to use it. I don't believe in value areas, in that whenever there's a computer draws a volume profile, it automatically shows you what the value area is. It draws and I'll show you in the next slide, it draws a green bar to show what the value area is for a market profile. This does not exist either, because not every market, not every day has value, has successfully found value. Only certain profiles represent value. Not every day does. Much of the theory and application of MP revolves around the time brackets, okay? Here's what a market profile looks like. This is based on today's action. See, the 5/14, May 14th is today's. And these are some of the characteristics, from the top left, high volume nodes. These are the areas that have the most letters. So this simply is telling us this is, if we count these letters right here, let me get my trusty pen. If you count these letters represented here, you're looking at 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 brackets. So those are, all this is saying is there were 10 30-minute bars that overlapped each other at that price. That's all it's representing. 10 30-minute bars that overlapped each other. How much did it trade at that particular price? We have no idea. It's not telling us that. We can ask, we can get the program to show us a volume profile for that, and that's the main difference between these two products, okay? And so a high volume node is the fat area of the profile, or the acceptance area of the profile, generally encompassing the point of control. The point of control is the POC, is the traditionally called the mode in statistics. It is the price at which the highest number of bars at that price had traded. Okay, so you can see that here there's a sharp POC a little bit, pokes up above the rest. Here as well. Here's just one letter, and so on and so forth. So the POC is the most traded price in that region, and it's shown here on IRT as a black line. That's where the POC is. An excess is essentially a stream of letters like this that shows that the market tested and rejected an area. This does not represent an excess. Generally, an excess is one where the market falls, and then you get the asterisk representing the last price somewhere up top, and the excess is below. On a candlestick, it just looks like a big wick below or above the market. Single prints are single letters squished between other areas. You can see that period M had a single print, M and N traded afterwards, and then P is the last 15 minutes. So this is a single print. I outlined this in day before yesterday's Trader Bite, where I talked about 98.75 being really important to watch. This is a single print here. You can see this is a rejection area. Single prints are also known as low volume nodes when we're looking at volume, and they simply represent low volume nodes represent areas of rejection. So a low volume node right here, and in between two distributions, a low volume node is this area here where the market's just moving through very swiftly. The midpoint is just the difference between the high or the average of the high and the low of the day. It's represented on this chart with this little square here. That's the midpoint. This is the whole midpoint concept. I used to build these profiles myself by hand, even though I had software to do it, just to understand it. And I noticed the market often responded at the midpoint, and that's where that idea comes from. So that's the midpoint. The value area is represented by this green bracket. And here's what I'm talking about when I talk about value. Let me clear the screen. I want to make sure you understand this concept. Just because the software says the value area is from here to here does not mean that's what it is. Because as you can see here, this was pretty much a trend day. B period opened, tested up, tested down. C period opened down here, tested up, and then D period opened right here, tested down a couple ticks, then pushed up, and so on and so forth. And you could see that the market really didn't establish value. It's an elongated profile. There's a lot of price discovery, and therefore value wasn't achieved, it wasn't discovered. Here, this value area for yesterday's action, I could see that a lot of trading occurred between here and here. But look at the value area. The value area is reaching through the low volume node all the way up into the upper extreme. That's not value. That's not value. Just because the program is designed to find the POC and then calculate 70% of the TPOs up and down until it's selected 70% of the TPOs does not mean that this 2838 is value. It is not value. However, on this profile, you can see how it's somewhat Gaussian, or it's a normal distribution curve. You can see that the market spent a fair amount of time here. This is value. So it's more important to me to establish this level and this level as value for that session and to pay attention to that than it is to look at this level here. Okay, this is value right here. Market kind of established value and broke higher later in the session, but you can see that there's a nice distribution there. It's a visual thing. Up here we see value. We see a lot of letters overlapping each other. In general, as a general rule, and I built a system around this in 2011, if we have 10 or 9 letters overlapping each other, then we can start to consider that value has been created. This here has those 9 letters, yet look at the value area. It's just a very weak low down here. You can see that there's a ledge, and then you have single prints, yet value is being established all the way up here. This is not value. Okay, so the day after it, as we come in here, I'm not going to consider that value is way up here. That doesn't work that way. So I want to make sure that concept is clear. But what you have in front of you here are the basic components of a market profile, also a volume profile, but we look at things differently because we don't have single prints and things like that in a volume profile. What is a volume profile? Volume profile simply displays volume at price. It's simply outlining volume at every price. uh, for any given time frame or duration. Organizes the volume information in the same way as MP does, but is not restricted by time. Time's already represented in the bars overlaid on the VP. So we could put time-based bars on the VP, we could put Rencos, PNFs, whatever. It has zero impact if the software is coded properly and is computing it properly and is showing it properly. It does not care if you're using a 60-minute bar versus a 15-minute bar versus a one-tick Renko. The volume profile does not change because it's simply telling you how many ticks or how many contracts traded at each price at every tick. Okay, volume at price is a more accurate measurement of the interest at any given price. I strongly believe this because it's telling you how much has taken place at that price. The more interest, the more volume there is. The advantages of a volume profile is it does not change the outcome of the profile, even if the time frame is changed. This is not true for MP. The data is the same for all participants, assuming that the tick data is accurate. So everybody gets to see the same information if they're using accurate tick data. It doesn't matter how you have your charts configured or what periodicity, you're going to see the same information as everybody else, which we kind of need that to get their support in our trades when we're trading value. Disadvantages requires a very high quality data feed from a reliable source, right? So your volume profile is not as useful if the volume is simply distributed over 1 minute bars. So services like Thinkorswim, Interactive Brokers, TradeStation, when they show a volume profile, the most granular they'll show, I believe, is a 1 minute bar, and they just distribute that volume equally. So instead of 30-minute TPOs, they're using 1 minute TPOs and representing that as volume by taking the volume that occurred in the 1 minute bar and dividing it by the range of the bar and the number of ticks and distributing it. This is not very accurate in the short term. It's okay for bigger picture charts. In fact, IRT does the same. Once it goes beyond, when it looks back at your composite and it goes beyond the tick data that we have saved in our database on our computer, it starts to use 1 minute bars, the volume over 1 minute bars, to compute the rest of it. And at that point, it doesn't really matter because we're looking at a big picture product. But for the intraday volume profile, we really want to use tick data because we want to identify really where the volume is. For most applications, you can get away with it, I think, but you'll notice some distinct differences. So this is a volume profile chart of crude as of an hour ago or something. The value area is represented in this color, this kind of maroonish color. This is the value area computed. Okay, the gray is out of value, and the maroon is the point of control, and the maroon extends out until it's touched by the ensuing day. Okay, so there's a lot of detail. You can see a lot of detail as to what happened at each and every price. So you can really see, when the profile, when you step back and look at the profile, you can really see how much volume took place at each price, and we can easily determine where the market's accepting prices and where it's not. And that's, and this here is a 60-minute bar chart. At the top is your 60-minute bar chart, same one as this one. I just squished it. Okay, same thing. At the bottom, we have a 1 tick by 30 point and figure. And you can see that despite the fact that I'm using point and figure at the bottom and 60 minutes at the top, these profiles are exactly the same. You can see these profiles all over the place are exactly the same. This is the key difference between the two. So let's move on to trading ideas. Okay, so that's why we're here. Trading value and establishment of value. So really important to understand that, as one of the concepts that I'd like to cover initially is to make sure that we don't just believe what the computer spits out. We don't just believe what the computer spits out as a line on our chart. Really, you have to look beyond and understand that a day like today, like this day, This is a price discovery day. This is a price discovery day. When price discovery occurs, when there's active price discovery occurring, there is no such thing as value. So there is no such thing as a value area as a result. It was never established. But a computer has instructions, and the computer's instructions are find the POC and compute the volume above and below every tick, above and below the POC, and add it to the value area until you reach 70% of the total volume of the day, and then stop. Those are the computer's instructions. So it will happily form a value area like here in crude 2482 versus 2247 when there really is a price discovery day. The day is in a trend. There is no value. Same here. The market's really zooming up and zooming down. There is no value. We see these days as impulsive or clear price discovery days. These are important days to track. But we see that here, the market was pretty much in balance. This is a 24-hour session. The market really tried, pushed to 24.99, pushed down to 23.50 or so, pushed up, pushed down, pushed up, pushed down. This is a market that is in balance. This is a market that is in balance. And so when we come the next day, the first trading concept I want to cover with you is that it did establish value, and that's when we come in the following day and use and rely a little bit more on the value area, always keeping context in mind, but rely a little bit more on the value area. By what do I mean by that? So let's focus on this day. Okay, this day is done, and this is Friday. This day is done. We come in on Sunday night, and what do? So let's read this auction as it happens. Okay, and I'll show you several examples of this so that you don't think that I'm cherry picking. So here we see that value is established. Okay, Sunday opens up right here in value. It tests above, tests below. And you can see it tests above value, tests below. And where does it go? It goes to value low. There it is. Oh, I missed it by just a couple of ticks. Let me redraw this. So we have it right. So there's value low and there's value high. Okay. So we could see that the market is attempting to get above value, but is unable to. It opened in value. So we immediately, because the prior day is a balanced day. So this is balanced. Okay. Important concept. Because it's a balance day and it opened inside a balance, we expect to fade that value area high, and we expect to trade around, or the market to at least respect the value area low. You can see it pushed through by a couple ticks down here, pushed through by a few ticks, 15, 20 ticks up here, and it just keeps coming back, tests it from below, and it finally breaks out. So now we're looking at balance moving into imbalance. Okay, we're looking at balance moving into imbalance, and the value area has been tested and retested. The entire value zone has been tested and retested. We've checked the top, we've checked the bottom, and we've broken through the top. So now we're looking long only because it held the bottom and it broke the top after testing the top and the bottom. And so we're looking for pullback trades. Hindsight's 2020. I don't know what this looked like on Monday, but Monday morning, but we're looking for pullbacks. And then for that, okay, well, how do you trade those pullbacks? Tell us how you trade those pullbacks. Well, the pullbacks are trading those pullbacks is a function of many things. Are you using the IB? Do you have any reference lines to work off of? Do you have any stock zones? Are you using the mid? Are you trading off of VWAP? Or are you trading off of order flow? These are just ways to kind of localize the price action to the day, and then trade off of them with the idea, the context, and this is what we're all talking about here. The concept behind volume profile is it helps us establish context of what is happening. And so we look to establish the the context, and the context is we were in value, we tested above, we successfully tested below and could not hold. We broke above. Now we're looking long. Now we're looking long. And so where do we get long becomes the next question. So we've established our bias. 4 elements that we have to figure out. Our bias based on context, our trade location based on whatever you want to use, moving averages, whatever, scalping, so on. So trade location, trade stop, the size of our stop, that determines how much we're willing to risk on the trade, and then your trade exit, whatever that is. It could be scale outs and exits, all in, all out, doesn't matter. Those are the 4 things we've got to get right in order to make money in trading. Would you all agree? I think you would agree, okay? And so we established bias. Now we need to establish a trade location. That's up to you. There are many, many ways to kind of skin that cat, so to speak. Next, we establish our risk. Our risk is built on our account equity size. We have to use a reasonable risk percentage. Our risk also has to be built on volatility, so we use either ATR or some sort of a historical volatility or something to figure out what our risk has to be, our minimum risk has to be, and then establish that risk based on structure, based on zippers, based on order flow, based on the volume profile, whatever it is. And then we're looking for targets, and targets are generally areas that are built on the past, or they're fixed areas for some people. Just, hey, I'm going to risk 4 points. I'm looking for 12 points, and that's it. I don't care if it runs to 24 or whatever. I prefer to use the structure of the market, because I don't want to hold something for 12 points on the market. It'll only yield 8 points for the day. It doesn't work. Okay, so this is a typical trading concept when it comes to value, and it's predicated on balance the prior day. Okay, and so this day here is somewhat establishes balance. You can see that it's traded a lot. Let me clear my screen as we continue to look at the anatomy of crude oil over the last week or so. So we see that the profile had a little bit of balance up top, but the main balance is down below, and then the next day it opens inside of that balance. And again, it could not, we're establishing that this is the value area for the day, and we've got a market that's opening imbalance. So the first trade we have is to monitor how this is trading up here. This probably will result in a loss, and then it never comes back. It never tests the prior value low in what we believe is a well-established value area. As you can see, the market came back the prior day, tested value low again, and closed right on its point of control, right? We shifted the point of control up, which is also an important concept. We're accepting higher prices in crude, but overall it did not test. So here we're stalking to get short, and we would have gotten run over, and it's just the cost of doing business. So we're only looking to the long side here, and we see that this day did not establish value at all. So the next day, despite the fact that it opened at something that's called value low, it's not really value low. What it did do is it went to the rejection area, to the low volume node, tested that, pushed to the other side. This is not really value either, although it worked out. And so on and so forth. But this particular day here, I wish there was a shortcut to clear the screen in this software. But we can see that this day here established balance. In its process, it established balance, and we can see that balance is there and there. Okay, opens inside of balance again. Okay, so crude is not really leaving balance behind. It did so back here, but on this day it closed inside of balance. On this day it closed inside of balance. So we establish our open just above. We're in balance. We test value high based on the concept that this is balance. We establish value high. We test value high. We fall back in. That's successful. We test value low. We fall back in. That's successful. Then we break value high, and then now we're pulling back to value high, which happens to also be around the mid VWAP area for today. And then it just continues higher, and we're in price discovery mode. You can see that the market traded quite a bit at 27, and it's got these prongs all over the place, and it's really pushing around. But overall, it really it's showing some characteristics of value, but we need to see how the market finishes up. If it finishes near highs, it really has run away, but the value area is still pretty decent here at 26.50. We can see that it traded a lot of volume. In a market profile chart, you would not see this value area at all. It would be a lot thinner profile. But for tomorrow, if the market opens in value again, we would check the first test of value high, the first test of value low, and see which side it breaks from, and then we trade from that side. Okay, so that's the establishment of value. Let me get rid of these markings. That's the establishment, the true establishment of value, and I also covered with you on that slide some just super basic trading concepts. The last thing I want to cover with you with regards to this is to remind you of what these things mean. What does it mean to have a low volume node? So this area here, if you look at how it came back and it left this thin, see that thin area here? That's rejection. And you could see that about here is where that started from. This is important to track later. This becomes a stock zone because I expect that since it rejected that price. I would expect the participants who are a part of that rejection will likely reject that price on a first test again, and that's what we see the next day. So pay attention to these low volume nodes here. That low volume node from this double distribution or triple distribution profile. You can see there was a low volume node, right? And so these areas that have no volume are rejection areas. Why would no one want to trade there, right? I don't care. I just know that this is a low volume node. I'm going to mark it. Boom, boom. Becomes like a bit of a stock zone, so to speak. And I want to see how the market treats it the next day. It's one of the things that goes into stock zones is how the market's treating these clear low volume node areas. And they are much easier to identify actually on a market profile because it's just, you don't have all these jagged things, but the volume profile gives you a true sense of what was rejected and accepted in terms of volume. Okay, so that's another concept. The additional concept is if crude was closing and it established value down here today and it finishes and it closes up here, what we have here is what's called an incomplete auction. An incomplete auction. And an incomplete auction says that some external thing, incomplete auctions are caused by running out of time and that the market is closing, or the SOC, which is caused by a news event. You know, we have a scene of the crime or a price from which we bookmark that price where the auction was interrupted. But in general, when the market runs like this and it runs out of time, especially if the point of control shifts to the upper part of the day where it's showing clear acceptance of these higher prices, we have a very strong probability of the market continuing higher. Why? Because it goes back to this slide way back here, which I really hope you'll kind of emboss into your head, and that is price moves like objects in a vacuum using Newton's laws of motion. Price maintains in directional motion until a force acts on it. And time is not a force, right? And if the market is moving directionally like crude is, it's just imbalance, it's kind of shooting higher and it runs out of time, that opposing force never was established. And so in general, if you look at it, somewhere close to 8 out of 10 times, it'll just keep going. So this is when you have an impulsive bar, that's where the idea of impulse, pullback, continuation occurs. An impulse is created by the early adopters, the smart money, so to speak, the macro guys, the fundamental traders cause that push in general. And then you have the pullback where profit takers come in or faders come in, it causes a pullback. And then those who missed, people like me, always miss that first move. In general, it's just an acceptable part of my career. That's not my game, is to create or catch that first move. Then guys like me step in on the pullback, and then we have the continuation. And that's why on a continuation long, I'm always looking for that last impulse high, because that's the best I can do, really, given this idea. But if it continues, then I hope to have a runner on, and it continues. And so we get on the second leg, and then we have the continuation leg, which generally is weaker than the impulse leg. That concept is really built on this Newton's law of motion, in that we're getting the opposing force, but then we have these people who missed the first move and want to get on that move, and they may be doing so on a swing or an investment basis. They're waiting for a trend line to break, a breakout of the EMA or some other moving average or whatever. And I'm a part of that push, the pullback for the continuation move. So that's another concept you need to be aware of. There are other things like the initial balance and how that relates to things, closing inside of the initial balance, breaking the top and bottom of initial balance. We've talked about these before. We'll discuss them in a different time, but I'm focused today on just the volume profile. And then that leaves us with one last VP concept, and that is when we have a market that is sitting in balance. Can anyone tell me, where did the balance start and where has it ended? Give me a guess. So I'll give you the dates. The dates are down here. You can see the dates somewhat. I'll show you where they are. These are the dates right here, right here, right here. That's May.
Yep.
So where did this balance start and where did it stop? Because we want to use this thing called a micro composite. And the micro composite is simply connecting multiple days together into one profile so we can see the overall picture, the swing picture. Where would you start a micro composite? Micro composite generally is something we want to use to describe a balance area. So we can see inside a balance. Where would you have it?
One says May 5th, another says May 10th, another says May 5th to 12th, another says balanced and on break May 13th, another says depends on your perspective.
Yes. So all of those are right. Why? Because of the last answer, that it depends on your perspective. But for me, it really is about seeing the market trading. It's like, have you ever seen those pictures where a snake is kind of eating its tail? It's when the market kind of moves in a direction, but then it just comes back and it falls into where it used to go. And it occurred the first time right here. So this day here is this a balanced or imbalanced day? What do you think? Does this day show balance or imbalance? Has the market discovered value here?
Everyone says imbalance.
Correct. So the market's imbalanced. So here, there's no establishment of value by definition because it's imbalanced. It's still discovering. It can't be balanced and discovering at the same time. The next day, so we have a big impulse here, big impulse. Okay. The next day, the auction is interrupted at the end of the day. That's the concept I talked about for the end of today. And so the next day has the continuation. The next day, this is, 8 o'clock at night, my time, or something like that on the reopen, and the market falls back in. It falls back towards the high volume node, tries to get out of the prior day's high right here, and falls back in. This is a market that has complied with Newton's motion, laws of motion, the first law of motion. It has found temporarily, for however long it needs to, we can't dictate it or know it, it has found that opposing force. Now, we want to measure that opposing force. So what we would do is establish a microcomposite using this day, but we don't do it during the day. We wait for this day to finish to see that actually these days overlap. You can see that the value area, which is not real, is inside of the prior day's value area, which is also not real, but it gives us an idea that much of the volume, or the highest portion of the volume of the day, is overlapping. This is a clue that we should probably start building a composite. So the first day this gets done, so this day is done, the 5th of May, nothing for us to do. The next day, we want to know, okay, what do we do here? The next day, does it continue higher on the impulse continuation from this day, or does it fall and then just does this, right? And what it did is both. It tried to continue higher, and it fell right back in. And where does it close? It closes right on top of the prior day's point of control. Now I can go and build a microcomposite. And at that point, I only have 2 days, and I'm going to start using this day and this day. So I'm going to draw it across these 2 days. And let's make sure we have, okay. So we're drawing it over these 2 days. And let me get rid of my drawing. I think we're going to run over time here a little bit, but I want to make sure you understand this. So now we've established that after the impulse up, the market really is balancing, is establishing 23.33 as the most fair price. We don't really have that much information. We can't lean on that idea too much. But what this composite shows us is there are 2 distributions here, really, that and that, right? So there's a kind of a low volume node that's being established. Let me draw that across. Okay, so between these 2 days, so the next day we see a test of that low volume node. We see a push in, an attempt to push into the upper distribution and failure. We see us breaking up and then holding above it for the next couple of days, and it becomes a dividing line. And that's what low volume nodes tend to do. They become this kind of a delineator or line in the sand between 2 distributions. Now, this day is inside of the composite. So we automatically start to, this is the easy part, we automatically start to include that next day. So we click on our composite, hold the control key, and use the arrow keys to go into the next day. And we see the point of control kind of shifting up, right? As the market is trading in balance, it's accepting higher prices. And you can see that the distribution, the lower distribution, is becoming much more distinct from the upper distribution. The next day also trades inside of this composite, which also trades inside of the prior day's value, so completely imbalanced. This is where people get frustrated and call it chop. So now our value area is at 2406, right? And then the next day breaks out, but still inside of the composite, but it's building that, see how it's building that upper distribution, and the low volume node is intact. See how that low volume node is becoming much more distinct between the upper and lower distribution. And then the next day trades in the upper distribution with a low volume node. And this is all in real time. I didn't really prepare for this. I just decided right before we started here to pull up crude. And what we have here is now a double distribution microcomposite, double distribution with a low volume node right here, okay, for the lower distribution. And it's really important for crude traders to keep track of where it is above or below. And I've used this concept to, say, trade options, right, with 3-week expiration or something like that, based on the idea that if it, as long as it holds the low volume node, and say I'm I'm looking for, I'm long a call or something like that, as long as it does not get below this line, I don't have to wait for it to fail to the other side to discover that my option is probably becoming worthless. Anyway, that's a separate idea. But in all of this, the low volume node is right there, and the microcomposite's helping us combine all of these volumes. All of this green profile is built on tick data. It's built on tick data. It's very, very accurate. And then we get into today. Today, we establish ourselves in the upper distribution again, because we did so yesterday after that inventory report and fail. We establish ourselves in the upper distribution. If it's not able to move lower, I expect it to remain in balance or break higher. There are no other options. And so today, I stop my microcomposite. Why do I stop my microcomposite? I cannot build my microcomposite for two reasons. One, the day's not over. And second, it looks like we're moving out of the most recent balance. So if the microcomposite also helps us detect levels that we may miss. For example, the high of this range is 2674, which is the high of this day. And then we come in this morning, and where's the high this morning? Same price, 2675, basically, before it failed back, and now it's pushing through. So what do I expect? I expect that this market, which is where the 2674 was, we have a low volume node in the profile. I expect that there's going to be a fight in this price, and this becomes the short-term line in the sand for crude for today if it ever comes back. Does it hold it and come back into the microcomposite and finishes somewhere in the value area below, in which case then I will extend this profile to encapsulate today's action. If it does not and it finishes higher, then what we know about crude is what we know about crude is it's breaking out of balance. It's finally breaking out of balance, and we can start to look at what destination there is above there. I'm sorry this ran over, but this is such an important concept. If you understand this, you can then overlay your fibs and trend lines and all that stuff. But the market is an auction. Accept that the market's an auction, and you don't have to use volume profiling. I'm not telling you have to use it. It's just a tool for organizing information. But having it helps us see what the auction is doing. And that's what today's session was about. Okay. Do we have any questions that I need to address here? I know we're way over our time.
Yeah, we're way over time, and there's a few, but I would ask basically, because we're over time, if anyone has questions, either ask them in the forum or post them for next Tuesday's webinar, or pre-post them.
Yeah, for the trade doc. Yeah, I apologize for running over, but it was more important to me to cover the concepts and provide as many analogies and angles as possible to help this kind of settle into your mind, because this is really important then to address questions. I'm happy to take your questions at next week's Trade Talk. This is stuff that I've been doing for 15 years, and I know this forwards and backwards, so I can answer this at any Trade Talk if you like, once you figured out what you want to ask. But I hope that I helped you see the value of looking at this, and really this is predicated on a good piece of software that helps build it. There's a lot out there, Sierra, IRT, I believe Ninja now does it, many different pieces of software. And more importantly, the data feed behind it has to be really, really good. But once you get that, you'll start to see what the insiders see. So on your bar charts, if you don't have a volume profile on your charts, what you see is a bar chart with a volume histogram underneath it that tells you the volume that went into the bar. With this, we get to see, this is kind of like getting insider information, because we're looking inside the bar to find out where in the day, in the 60-minute, in the 30-minute, whatever it is, where participants really battled, right? And that's why it's such an important concept. And I have not changed the way I trade since I figured this out and started to use it. I have not changed it at all. So I'm not constantly kind of reinventing myself. Once I've figured this out, this kind of describes any auction out there for peanut butter, cars, houses. the market for cotton, cocoa, lumber, orange juice, pork bellies, bonds, whatever. It's the same concepts. Okay, so we'll wrap it up here. I'm happy to take your questions at the next Tuesday's trade talk for this if you like. I apologize, we ran over and we couldn't address all these questions, but you can always start a thread in the forums and link to it from the lounge in the chat room, and I'll do my best to get over there and answer your questions. Thanks, Yoda, for moderating. Take care.